Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company, LifeChamp. Today, our webinar title is Inflation and the Sectors to Benefit. So welcome to this session. My name is Shen Chu. I'm the moderator for this webinar. Now, inflation has been getting rampant over the past 1.5 years. And recently, has the inflation been subdued or is still on a rampage? So today, our webinar is going to address this question, and we're going to explore where are the investment opportunity in times like this. So before we begin, as usual, disclaimer, whatever is shared in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to introduce our speaker today, and he's none other than Mr. PC Wong. Now, Mr. PC Wong is a full-time investor, author, and trainer. He has almost 30 years of investment experience in Bursa and 14 years of investment experience in the foreign markets, namely Hong Kong Exchange, Singapore Exchange, NASDAQ, New York Stock Exchange, Australian Stock Exchange, and London Stock Exchange. He is a best-selling author of Invest in Foreign Shares and Invest in REITs. He has also published 2 ebooks, Global Economic Collapse and 2023 Water Rabbit Year, Chinese Astrology and Global Trends with Evelyn Tan. His area of expertise includes geoeconomics, geopolitics, and broad sectors in the resource industry and REITs. He has 8 years of experience teaching retail investors in local stock as well as global stocks. So academic-wise, he graduated from National University of Singapore in 1989. So welcome to this webinar, PC.
Hi, thank you, Shane, and thank you all who are logging in.
Yeah. So are you ready to kickstart the session?
Yeah.
All right, let me hand over the session to you.
So there's something wrong with my camera, so I'll just continue from here. So today's topic, we will discuss what is the definition of inflation and CPI, what causes the CPI to rise, why inflation will remain persistent, and some countries could see hyperinflation. And we will talk about the cycles of inflation and what sectors will benefit from this inflationary cycle. So first and foremost, the definition of inflation. Now, a lot of people like to associate that inflation is when there's price rise, okay, in goods and such. But actually, inflation is the expansion of money supply. Now, by expanding their purchases of assets, major central banks of the world are effectively expanding the supply of money. And price is always a laggard, which comes after the expansion of money supply. So as this is very purely economics, because as the supply of the currency expands, inevitably, price would be the determinant. And therefore, the price will actually the value, is the determinant. So the value will drop as the expansion of money supply increases. And that is why, as the value of the currency drops, the price of goods becomes more expensive. So CPI, on the other hand, or the Consumer Price Index, measures the change in the consumer price of a basket of goods and services over time. So a lot of people are complaining about inflation, since a few years ago, but actually it's not localized, okay? Now, the current inflation experience in Malaysia is a global phenomenon, okay? It is not only in Malaysia. If you have read the newspapers all over the world, okay, especially in some emerging economies, they are even seeing hyperinflation. For example, we have Sri Lanka, which has witnessed a collapse of its economy. Egypt, Turkey, Pakistan are also facing hyperinflation, and Argentina as well. So if we look at it, who are the culprits? Now, here are the top 4 major central banks who actually have been expanding the money supply since the last financial crisis in 2007, 2008. They started somewhere here, but all through the years, they have actually been expanding. And I think the chief culprit is actually the Fed and the ECB. So they reached a peak somewhere along here. And then what happened next was the inflation rate in Europe, in the EU countries, as well as the US, started to rise. So from inflation is transitory, it becomes inflation is a fact. So what happened next was the central banks of like the Fed and the ECB started to increase rates. And as they increase rates, the value of their currency starts to increase as well. And therefore, we see inflation going down slightly from its peak. But nevertheless, if we look at here, the BOJ, okay, have really not gone on a increase in any interest rate. Rather, they have been continually buying up their bonds, okay, and further expanding their supply of currency. And the PBOC, the Bank of China, has also been using a lot of operations, what we call central bank operations, to continue to pump liquidity in the market to help the economy, because China economy has been closed for almost 3 years because of the pandemic. And therefore, when they reopened, it started to inject liquidity back into the system. Now, collectively, the 4 largest central banks, okay, currently owns $28.5 trillion in total assets. So this has actually been quite a remarkable expansion of money supply. If we look at it over here, the 4 banks, okay, previously were actually, when we calculate all the total assets that they hold, is actually less than 10 trillion, okay, which means it has gone up by almost more than double the amount. Now, what happened was that over the last 10 years, 4 of the world's largest central banks by total assets, okay, have collectively printed 15.9 trillion. And what happened was that the aggressive interest rate hikes, which ensued, helped pull the price of commodities lower. So here is a period of this is the Goldman Sachs Commodity Index, okay? And this is a period where there was an oversupply of commodities. And subsequently, when the central banks all started to expand their money supply, it was a period of easy money. And because of this period of easy money, a lot of the major corporations of the world, instead of investing in productive activities, okay, like increase in the production capacity or improving the mining infrastructure, they actually went ahead and started to use the easy money that they get from the banking system to buy back shares. Okay, so there was a period of financialization of assets. So subsequently, because not much money is put into production, improvement of production capacity and improvement in the mining infrastructure and development of mines, when inflation started to hit, okay, it went on a very steep curve. So this is when we realized that there is not enough goods, not enough raw materials, okay, to manufacture the goods to supply to the global market. And subsequently, we see the commodities index going up and reach a peak somewhere around here, where from here onwards, you know, the Federal Reserve as well as the ECB started to increase interest rate, and then the commodity index actually started to trend down. Now, a lot of people were saying that if let's say they continue to increase interest rate, then the price of commodities would actually go down lower. But sometimes interest rate hike can also result in higher price of commodity, which I will explain as we go along. Now, what are the reasons for the increase in CPI? Okay, CPI rises due to the following reasons: rise in the cost of inputs, especially raw materials and labor, both of which are passed to the consumers by the manufacturers. And there's also supply imbalances, such as sanctions arising from geopolitical tensions. Already we have the G7 as well as EU sanctioning Russia. And the point is, Russia is the world major supplier of important commodities. They are the major supplier of oil and gas, copper, nickel, platinum, palladium, all sorts of minerals that are very important for the industry. And then they started to sanction China's technology companies. And the thing is that China is the production house of electronics. So when you sanction the Chinese technology companies, inevitably, okay, it will cause a shortage of goods in other sectors as well. So that is why supply imbalances have given rise to increase in the price of goods. Then there's also supply imbalances caused by underinvestment in the extraction of raw materials. Okay, for example, let's talk about oil. Okay, now, because of the ESG guidelines, banks are disallowed to lend money to companies that want to finance a project like oil exploration and such. Now, because there's no financial backing, so there's underinvestment in exploration, and without exploration, then there won't be enough extraction. Okay, and similarly for other minerals as well. So there's also underinvestment in expanding the production capacity. As I mentioned, most corporations decided to buy back shares instead of expanding the production capacity, so that company have high productivity, and therefore consumer also enjoy lower price of goods. And then there's also the underinvestment that is made worse by high interest rates, which increase the cost of financing projects and business expansions. So when interest rates have reached a certain stage, okay, a lot of companies do not want to invest in expansion, okay, because companies normally do not have a lot of, they rely on cash flow, okay, they rely on borrowing to help finance large projects that will allow the company achieve productivity or help to lower their overall costs and improve their overall efficiencies. So because of the high interest rates, a lot of companies decide to pull back, okay, from making investment, and therefore we have underinvestment as a result of high interest rates. And that is why when there is a demand that is expanding, a demand that is rising, suddenly there's not enough goods. Okay, when high interest rate, no one wants to invest. But then when economy finally righted itself, and then it's on an upward surge, suddenly there's not enough goods. And then what we have is another inflationary cycle. So the other thing is that political pressure and economic collapse, which prevented some countries from exporting their agriculture products. And this is very true because although some global inflation has come down a bit, but food inflation is what we call sticky inflation. Okay, it's very difficult to bring down the price of food. And that is why, because of certain countries that produce food, okay, they have high inflation, the government is pressured, okay, the last thing that government would want is to create, if they have ample food, is to create food inflation within that country itself. Okay, that will actually bring the collapse of governments. So what they do is they come up with policy that we are going to slash our export market so that we stockpile our food to ensure that we have enough food, okay, despite the inflation. So then there's also political upheavals, which can result in stoppage of important economic activities and putting pressure on the global supply chain of important minerals. Now, for example, let's say there is this ESG guidelines, okay, that is imposed by the European countries, okay. So what happened is that they forced a lot of countries to, within the EU itself, to do away with fossil fuel. But then what we have, when the Russian sanctions were enforced, we have the entire Europe having not enough energy. So because suddenly they decided to cut Russia off, and how they make do with the loss of the cheap gas, they buy more expensive LNG from China, okay, which China actually bought from Russia. And then they bought oil products from India, refined oil products from India, which actually India bought from Russia, okay. And it makes the cost of energy very expensive. So suddenly the ESG economy is no longer an important guideline, because Europe has been one of the largest importer of coal. So that is what I mean, that certain political enforcement, okay, can also upset the supply imbalances. So then the other thing is that CPI can also rise because of currency weakness versus the USD, caused by the disparity in interest rate. So because the US have been hiking interest rate, the US dollar has been strengthening. So this put pressure on a lot of emerging economies, which actually borrowed US dollar, okay, to finance the government projects, government economic stimulus and all sorts. So imagine when that time, let's say Malaysia, when Malaysia borrowed US dollar, let's say it was around the 4 ringgit to US dollar. Right now it's closer to 4.4. So suddenly the cost of servicing that debt has become 10% more expensive. And that's why we have a lot of emerging economies having a lot of their government finances being stressed, okay, because of the disparity in interest rate that weaken the local currency and force the price of goods much higher. So why inflation will likely to persist? And I think everything that we know more recently is, of course, the banking crisis in the US. Now, the central banks of the world, the Fed, ECB, and BOJ are facing mounting pressure ever since inflation rears its ugly head. Now, the Fed started a series of aggressive interest rate hike, only to see a banking crisis exploding in the midst, resulting in the failure of 3 banks: Silvergate Bank, Silicon Valley Bank, and Signature Bank. And how did the Fed react? Okay. Its total assets rose 392 billion since 8th of March. And some people say it's QE, some say it's not QE, but nevertheless, what is important is that the Fed total assets have expanded, and that means an expansion of money supply. So in the 2 weeks, the Fed has actually unwound its 68% of its QT. But most recent data suggests that it has come down by close to, if I'm not wrong, close to about 80 or 90 billion. So it has come down a bit because the Fed is saying that the banking crisis is over. But actually, the banking crisis is not really over, because a lot of banks are facing quite a lot of stress. But let's not dwell into that because that's another topic. Yeah. So then in the EU, a number of European G-SIBs, what we call global systematically important banks, are showing signs of stress after the implosion of Credit Suisse. So some of the weaker European banks are actually Deutsche Bank, Commerzbank, Societe Generale. So these banks are very highly leveraged, okay? And if let's say another bank start to show weakness, then it will spread to other banks as well. So many have seen their credit default swaps rising as the cost to insure the banks from a default skyrockets. So further bank failures will prompt the ECB to act, and the only way to bail out the banks will be another round of massive QE, which is an expansion of money supply. So you can see that the central banks of the world, whenever they want to solve a crisis, okay, is always printing more money, expansion of money supply. So that is why, even though inflation has been reduced after some serious rate hikes, but because their solution is always printing more money, and therefore we have what we call inflationary cycles. So this is the first cycle of extreme inflation that has been the result of ongoing easy monetary policy and expansion of money supply ever since the global financial crisis. So in the IMF playbook, they would encourage like emerging markets economies, yeah, when a country is facing financial stress, the IMF would set the guideline. If you want to borrow money from the IMF, you need to raise your interest rate above the inflation rate, and the government must cut spending. So you can see that how hypocritical that is, because right now, when the countries that control the IMF, okay, mostly European countries and the US, they are facing inflation, but none of them are actually raising interest rate above inflation, nor are they forcing the government to cut spending. So the European economies continue to spend, because if they don't, then the economy will collapse. So if like US, you know, every year their budget deficit keep on increasing. By right, they should have cut spending to reduce the inflation, but they are not. So right now they have reached a debt ceiling. And most likely the ceiling will be increased much higher, and the government will continue to spend because there's a lot of geopolitical that the US need to get itself involved in, okay? They can never reduce the spending, and that is why the only way that the government can continue spending is print more money. And that is why whatever that the Fed does right now, it will never be able to bring inflation back to the 2% target that they wanted, because the US government continues to spend. And right now, there's a lot of crises that are unfolding one after the other. So you can see that the ECB's action will be no different from the Fed's as well. Okay. Now, the EU's CPI has risen from 5.9% to 8.5% year on year in 12 months. And the BOJ is not even bothered to reduce its balance sheet as it continues its massive QE to suppress the 10-year JGB below 0.5%. So any surprise that the Japan CPI has risen from 0.9% year on year to 3.3% year on year in 12 months. Now, if we look at percentage-wise, you might say that, hey, it's no big deal, you know, it's just an increase of 2.4%. But if you look in terms of percentage-wise, you know, inflation have actually increased by 300%, right? So ultimately, in order to save the financial crisis from happening for a second time, central banks will resort to QE, which is inflationary. To do otherwise will result in the implosion of the financial system. And right now, although Yellen have said that there's no banking crisis in the US, what the US is facing right now is a potential credit crisis, because the M2 money supply on a year-on-year basis have fallen to a level not seen since the Great Depression of 1929. So this is going to be a major credit crunch. Now, for those of you who have followed me for quite the number of years, I've often said that the GDP growth has been driven by credit growth. So much so that credit growth lead the GDP growth by a factor of 2.8 based on the data from the World Bank in 2021. 2022 is not out yet. So you can imagine that if we withdraw credit from the market, negative credit growth, what do you think will happen to the global GDP? It will collapse. So what happened right now in the US is a credit crunch, and there's also a commercial real estate crisis. And some primary A-list commercial real estate in the US has been sold at a 35% discount from the purchase price. And Blackstone, one of the world's largest REIT company, is stopping people from redeeming, their REITs, the funds. So these are all telling you that there's a lot of crises that are coming ashore. It's like a wave after wave because of the sudden tightening by the central banks. But the only solution that they know to save the economy and to save the financial system will always be to print more money. And that is why inflation will persist going forward. So again, I want to share with you, just so that you have a clearer picture. Now let's look at the global GDP, from 2009 to 2021. Total gain of 36 trillion, but global debt from 2009 to 2021. Total gain is 194 trillion. So from 2009 to 2020, total GDP gained 40.9%, but total debt gained 157%. And then from 2009 to 2021, just 1 year later, global GDP gained 59.9%, but total debt gained 178%. So that growth outpaced GDP growth by a factor of 3.9 in 2020 and outpaced GDP growth by a factor of 3 in 2021. So creation of credit is expansion of money supply, which is inflationary. And without the continual issuance of debt or creation of new credit, there is no GDP growth. So that is why we are on the edge of a reckoning where global GDP is concerned. And if, let's say, some of you have read the most recent IMF report, it stated that it foresees that the next 5 years of global GDP growth will be at around 3%, which is much lower than the average since 1995, if I'm not wrong, which is at 3.8%. So, but I think the IMF is being too optimistic. And a lot of time, whatever the IMF projected is always based on optimism. No one likes to forecast pessimism. So why eventually as governments continue to spend, they do not have enough money to service their debt. So that's why I say, according to the IMF playbook, to defeat inflation, governments need to cut spending and raise interest rate to 1% above the prevalent inflation rate. But the Fed, ECB, BOE and BOJ cannot afford to do that due to their country's overwhelming debt. And this is an example of the US debt trailing 12 months. You can see that after this period of interest rate hikes, the interest payment on debt for the US government has actually gone up. Now, this is actually $766 billion, okay, trailing 12 months. And I think the most recent data that I seen yesterday was 812 billion, if I'm not wrong. So as interest rate goes up higher, the cost of servicing the debt becomes much higher. So how long do you think that the US government can continue paying through the nose? Ultimately, they will ask the Fed that, nope, you have to monetize all the bond and force the interest rate lower so that we can continue to pay a much lower interest on the debt. Okay, and if not, at the rate that is going, eventually the service of debt would surpass $1 trillion, which is equivalent to 25% of the US tax revenue. So can you imagine if you are, if you are a working person, 25% of your net income, okay, after tax, after KWSP deduction, you need to spend 25% just to service interest on debt. Nothing to do with your mortgage, yeah? Just debt, like credit card debt, okay? So with global debt to GDP at 343% at the end of Q3 2022, the next thing to search will be interest payment on the debt, according to the IIF. That's the International Institute of Finance. Many governments need to raise debt in order to pay interest on debt, and this is the irony of it. Therefore, they have no other option but monetize the debt in order to keep their respective governments from defaulting. So it is really an irony, because to service that high interest debt, it needs to, as the Fed continue to increase interest rate, it needs to borrow more money, okay, at a higher interest rate to service that debt. So that is why, if they do not want to put a stop to this, it will go hyperbolic. And that is when the US will likely to default. So the other thing is energy crisis. Now, I would like to suggest that if you are interested in energy, go and look up Steve San Angelo. And he has a very interesting concept called the EROI, which is the energy return on investment. So what it basically means is that it costs more to produce a barrel of oil than it did more than 100 years ago. He actually have a very interesting chart that shows that adjusted for inflation, the money that is spent 100 years ago, let's say, can produce 100 barrels of oil. Adjusted for inflation at the current price, it can only produce 10 barrels of oil. So that means that what the cost of oil extraction will continue to be more and more expensive, because near surface oil has been depleted and it costs more to extract oil from an ever increasing depth. So at some point in time, the cost of extraction will be so high that oil price has to rise in tandem to ensure supply meets demand. Underinvestment in exploration and development of oil fields due to the ESG agenda. Okay. It forbids bank and development, especially in the EU as well as in the US. So renewable energy development is also falling behind rapid deceleration in fossil fuel investment. So, the G7 come up with Build Back Better and all those, but, announced 600 billion allocation, this and that, but there's no project, because all the governments are actually technically bankrupt, okay, because of their excessive debt. So renewable energy plant and equipment require raw materials to fabricate, and they require oil to be consumed in order for them to be extracted. Now you can imagine that if most of the mines and minerals extraction, those are in very far off places away from the grid. How would they be able to extract the minerals without consuming oil? Does it mean that even before they extract the minerals, they need to build up a solar farm, okay, just to generate the energy to mine the mineral? No, it won't happen, because oil is still the cheapest energy-based product to be consumed for extraction. So energy crisis itself would turn into an inflationary will turn into an inflationary crisis if what Steve and San Angelo says become true, that unless the price of oil really escalate to offset the cost of extraction, then the world will face a shortage of energy. And if let's say the world faces a shortage of energy, like it or not, inflation will also be going up, because energy is the center of all economic activities, whether it is in manufacturing, whether it is in services. Yeah. So sanctions against Russia, which is the world's third largest oil producer and world's second largest oil exporter. It is also the world's second largest natural gas producer and world's largest natural gas exporter. So when you take Russia out of the equation, what happens? Europe has shortage of energy, but doesn't matter. Europe is still buying from China and India, which are actually buying from Russia to sell to Europe at a more premium price. So the US $60 per barrel price cap by the G7 and EU will cause imbalances in the global supply of oil, and therefore we can already see that it is a failure, because oil is right now trading at more than $80 per barrel. And potentially, oil could actually move up higher. Why? Okay, let's look at the OPEC production cut. In fact, a lot of people were saying that oil, with all these interest rate hikes, oil price would actually continue to fall. I was one of those persons that say that, there's always the wild card that OPEC will actually undertake a production cut, even though they have already done one, okay, last year. Because most important thing is OPEC countries want to maintain its margin. You remember the EROI? Because the cost of extracting oil within OPEC countries will also escalate no matter what. Therefore, it needs much needed funds to diversify from its oil-centric economy. And you can see that Saudi Arabia is looking into building solar farms. It is looking at building a lot of infrastructure projects, creating very self-sufficient cities like the Line. Okay, so all this actually is a means for them to diversify. And if let's say they allow oil price to fall, where are they going to get the funds from? So that is why OPEC would always look at opportunity to maintain that margin. If let's say we are going to have a severe recession, what OPEC will do is that because of slowdown in the demand, they will actually cut production, oil production again. Okay, because that's lower demand, but they want to maintain the margin. So that means that however the economy is, OPEC will always see themselves as having the say in how to adjust their production in order for them to meet their margin. And there's also potential cuts from Russia. Okay, in fact, so far Russia have only cut 500,000 barrels. And a few months ago, Goldman Sachs wrote a report that if Russia cuts 1 million barrels of oil per day, the price of oil will be about $100 per barrel. If Russia cuts 3 million barrels of oil per day in their production, oil will be about $120 to $130 per barrel. Sorry, $120 to $150 per barrel. And if let's say Russia cuts 5 million barrels of oil per day, it will be $200 per barrel. So because it is OPEC Plus and Russia that controls the oil industry, yeah, and they will actually adjust production to protect their margin. Now, the other thing is that not only OPEC, because right now, due to the global demand for lithium, there is right now a consortium of South American countries are banding it together, wanting to create an OPEC-like cartel that would actually control the price of lithium and the lithium resources within their country. So that is the kind of things that is going to happen moving forward. Yeah. So the other thing is that China reopening will exert pressure on the demand of oil, just as the US needs to refill its SPR, the Strategic Petroleum Reserve. Oil price will rise in response. So far, the US have not increased its SPR, despite oil price falling to $70 over per barrel a few weeks ago. And the SPR right now is down since February 2022 by about 36%. So if the US continue to release oil from its Strategic Petroleum Reserve in order to prevent the price of oil from rising, how much longer can the US do so? So a lot of people like to say that interest rate hike will force the price of oil lower because US dollar value increase. No one has actually thought about the SPR. Now, if the US start to refill its SPR, it will create a demand dynamics for oil because it will compete with China reopening. So that's why the increase in the price of oil, we have not really seen it yet because US have not started refilling, and China has not really started seeing tremendous amount of economic activities. Only in the last few weeks of March and in the early week of April do we see more clear indication of the China reopening, because by summer and autumn, China would actually increase passenger flight by more than 1,000 over flights per day. Can you imagine how much pressure that will exert, okay, on the demand for oil? So the price of oil, I think, has way to move higher, okay? Now, always remember, oil is the center of all economic activities, okay? If let's say what I shared with you just now, all this come into play, then definitely we are going to see the inflation cycle, renewing with much more vigor. Then let's talk about sanctions. The US, EU, and G7 have widespread sanctions against Russia and China. Now, Russia is a major commodities exporter, while China is the world's factory. Sanctions have resulted in imbalances in global supply chain, causing inflationary pressure across major developed and emerging market economies. So just like the US sanctioning China chips companies, okay, who will benefit? The Chinese companies in the semiconductor sector will actually benefit because US can no longer sell to China. Okay, so, but if let's say these companies cannot sell to China, they wouldn't have they would actually have a huge chunk of their revenue and net profit being taken away. So what incentive then are for these manufacturers to spend more on R&D? Okay, so, and what they also will experience is that a lot of inventories that are being produced in recent months suddenly have no market. So what they do, they have to dump it into the market, and therefore these companies that are not being able to export to China will actually see an erosion of revenue, erosion of earnings, and erosion of R&D funds available. Okay, so it affects different countries in different environment. Okay, but sanctions actually will just create a lot of inflationary pressure in certain pockets of society on a global scale. And the other thing is that military conflict and the war economy. Now, there's an MP from UK that says that the UK needs to embark on a war economy, okay, to counter Russia, which means they have to, and what it means by a war economy is that whatever raw materials that is dedicated for the production of consumer goods will be withdrawn and put into the production of military equipment. And if military equipment, okay, has no other economic enrichment, okay, other than going to the battlefield, get destroyed, okay, and that's it. There's no so-called multiply factor, okay. So the world is moving closer to wider regional conflict, and US is beating the drums of war against Russia, China, and Iran. Military conflict will herald a militaristic economy where competition for raw materials will drive the price of commodities higher. And you can already see that under the pretense of national security, a lot of countries are actually withholding, okay, their mineral resources. For example, just now I mentioned that consortium of South American countries want to control the lithium resources. Then there's also Canada, which actually decided to brand lithium as a national security and kick out the Chinese investor. So when a lot of countries started to see their minerals as a national security, what happened is that suddenly on the global scale, there are 2 or 3 very cost-efficient producers. We suddenly have 10 or 20 producers who wants to produce because of national security. So what happened is that all of them will be rushing, okay, to secure feedstock from the global market in order to make their plant more efficient. And that will create a competition for feedstock. Feedstock are actually the raw materials itself. And because of that, then we have price of commodities moving higher. So that is why militaristic or economy or on the pretext of national security would only drive cost inefficiencies, because there's a distrust among nations on who should benefit. Okay, then there's also the exponential debt to finance the war machinery, okay, which will lead to huge devaluation of major currencies, pushing inflation higher. Countries involved in a military conflict will prioritize the production of war equipment and ammunition over the production of goods for consumption, resulting in higher inflation for consumer goods. Not only that, there's also going to be rationing. So a war economy is unproductive and costly for any nations. So let's talk about currency turmoil. I think some of you all might have read about the dollarization. Okay, in fact, I've talked about the dollarization for many years already. But the most recent momentum, is far greater than any we have seen over the last few years. So currently, about 2/3 of the world is moving towards the dollarization. And if we talk about those countries that are wishing to join BRICS, okay, which consists of Brazil, Russia, India, China, and South Africa. There's around 15 to 20 countries that are lining up to join BRICS, and most of these countries have high population, okay? And if they join BRICS, then they actually constitute about 2/3 of the world population. And this is because the US has abused its power as the global hegemony by weaponizing the US dollar and SWIFT. And these are some of the latest trends towards de-dollarization. Brazil and China announced that they will now trade with each other in local currencies. Saudi Arabia announced that it is ready to trade with India, Pakistan, Central Asia in local currencies. Saudi Arabia has recently announced that it will trade with China in renminbi. China and UAE just settled their first LNG trade in renminbi. We'll likely see wider GCC participation in the RMB trade. Now, there's also talks that ASEAN will reduce their dependence on the US dollar, euro, and yen in trade among the respective countries. Both Bangladesh and Malaysia have agreed to settle trade with India in the Indian rupee. There could be a currency turmoil as use of US dollar plummets, causing inflation shock in the US, which could affect other countries as well. So we are going to, depends on how quick, okay, BRICS will actually roll up their reserve currency. News is that in the coming summit in August, during the BRICS summit, they will actually unveil a pathway to the BRICS reserve currency. And there are a lot of talks that this BRICS reserve currency will be backed by gold, and perhaps later on will be added with other major commodities like oil and gas and silver, depending on those countries, okay, which are joining and have that vast amount of resources, okay? So Mexico, even Mexico, you know, that is just south of US, is voicing its interest to join BRICS. So if, let's say, all these countries move towards trading in local currencies, then the US dollar, demand for US dollar will actually fall. And that will actually cause a currency turmoil. But I think overall it's good for the global economy, because the US have used the US dollar to suit its purpose, okay, like sanctioning countries and all those. You can imagine that Mark Rubio, one of the senator, I think, said that, with all these countries, joining, de-dollarizing, we have no longer weapons to sanction people, okay, which is precisely why people want to leave the US dollar, because the US has used the US dollar as a weapon, okay, sanction countries, and therefore the worst thing was they decided to seize the assets of the Russia central banks. So that is why collectively a lot of countries have decided that if we can at any time have our assets being seized by the EU or the US, there is no incentive for us to keep the euro or the US dollar as a reserve in our central bank's reserves. So definitely, I think when there's a currency turmoil, what could likely happen will be a very steep spike in inflation, similarly like the 1970s, when US decided to take itself off the gold standard, okay? And that was when, the price of commodities all spike, okay? And gold during that time, from $35 per ounce during the 1970s, went all the way up to $850 per ounce, okay, which is almost, I think, 22 or 23 times higher. So we are actually seeing a new version of it, in that right now people want to de-dollarize, okay? No doubt, I think very pro-US dollar community would say that, it cannot happen, even right now, agreement that we sign, with other parties, is still in US dollar. Yeah, it depends on how fast the momentum will build. But gradually, we are seeing that more countries are more vocal, okay, in supporting a trade using local currencies. So inevitably, the US dollar demand will actually fall. So why the US is so worried, okay, about its the prestige of the US dollar, and this is how the US dollar hegemony works. When trade is done in the US dollar, okay, all central banks must keep US dollars. So what the US does is that, hey, we have the ideal solution. If you keep US dollar, you cannot earn anything. Why not you buy our US treasuries, okay? And you can earn an interest. So then the US print the US treasuries, okay, send it over, which the central banks buy the US treasury to keep it in their reserve, allowing the US to rack up tremendous debt because the inflation is being exported to countries outside the US dollar. Now, if let's say a lot of all these countries suddenly decide to, hey, we want to trade in local currencies, not in US dollar, what will happen is that the US dollar will come flooding back to the US. And what we will have then is that the US will experience high inflation, okay? And the price of commodities would actually shoot up as well because commodities is still being traded in US dollar on the wider scale. And that is why if more countries band together, they may not be able to feel that great an impact. And in some manner, have helped them avoid the tremendous inflation that the US will face. So what is inflation in Malaysia context? So Malaysia, like any other country, is caught up in the global inflation, okay? February inflation rate is 3.7%, whereas the Bank Negara's OPR is at 2.75%. Now, here again, because the OPR is below the inflation rate, therefore there is pressure on the ringgit, okay? Invariably, as long as the OPR stays below inflation rate, okay, some inflationary pressures will remain. But I think why Bank Negara is adopting a very cautious step, because Malaysia household debt Malaysia household debt to disposable income, according to Trading Economics, when compared to peers, okay, Malaysia is 67%, okay, Thailand is 87.5%, Indonesia is 16.3%, Singapore is 49.9%, China is 61.4%, South Korea is 105.3%, okay. So Malaysia is not in the danger zone as much as South Korea and Thailand, but it still remains quite high. So I think one of the key things is a lot of I think Malaysia has a lot of debt being invested in real estate. And if let's say the OPR becomes too high, then the cost of debt servicing among real estate buyers, okay, or homeowners will be quite high, and that could actually cause some issues. So sorry, it's GDP. So Malaysia household debt to GDP seems manageable, but further OPR could result in higher interest payment on debt, which will then put a pressure on the household. But if we look at it, Thailand and South Korea should be even more concerned because South Korea right now is seeing a greater deterioration of its economy. Again, because South Korea is one of those countries that align with US not to sell their semiconductors to China. Okay, so and when the economy deteriorate, okay, in GDP sense, then the household debt to GDP would become much higher. So one way is that why some central banks decide to keep interest rate within the means is such that it encourages economic activities. So if, let's say, the economic activities start to show growth, then the household debt to GDP would actually come down. So that is why fighting inflation is not something that is very simple, okay? And I think to such an extent that central banks, I think central banks in Asia are a bit more careful versus the Western counterparts, because you can see that a lot of the like the ECB and the US and the Fed, okay, their debt is very, very high, okay, whereas I think just look at US, the government debt to GDP is already 125%, somewhere around there, okay, but Malaysia is still in the 60+%. So it's not as bad as that. But one of the key things is that, you know, if certain policies are adopted, okay, and GDP can actually start to increase, then overall the pressure on the Malaysian government would be lesser, because when rating agencies rate a government's debt, they do not only look at the government's debt to GDP, but they also look at the household debt to GDP, the non-financial debt to GDP, to work out a matrix, which then they apply a certain rating. So that is why, you know, that sometimes is easy, okay, but when it becomes overblown, managing it can be very difficult. So how can we help lower inflation? Okay, of course, you know, the most often used method is increasing interest rate, okay, but it increased government borrowing costs. So according to a report by NST published on 17 January, Malaysia's government debt to GDP now stands at more than 80%. Okay, this is the report. Okay, so if, let's say, the interest rate is high, then the cost of servicing the debt will actually start to escalate. And without unless the GDP is the economic growth is so strong, so that the government would actually have the tax revenue higher and all those, then that can actually help the government to offset that debt. But if, let's say, economy is facing a slowdown, the pressure to service that debt will become greater. So this is a worrying sign, okay? If borrowing cost increases without sufficient surpluses, the debt could easily spill over 100% of GDP. So this is a similar case that is faced by other emerging economies as well, because of the sudden aggressive hike by the Fed, it has actually spilled over the problem to all over the world because of the reliance on the US dollar. So I think one of the key things is that trading with major trade partners in bilateral currency swaps is a plus, as it helps the country navigate against US dollar volatility and away from the Fed's manipulative policy to protect the US at the expense of other nations, because the Fed wants to protect the interests of the US. And because the US dollar is used on a global scale, what the Fed does will influence a lot of countries globally. So I think by trading away from the US dollar, it actually helps the country, okay, in some manner, because there's no need to keep on keeping US dollar, okay? And the more demand for US dollar, the higher the value of the US dollar. So if let's say countries start trading in local currencies, there's less demand for US dollar, then the US value versus US dollar value versus the local currency will actually start to depreciate. And that would actually help the government in managing its finances better. So that is why right now, there are so many countries that are talking about moving away from that. In fact, quite recently, our Prime Minister actually suggested to China to look at an Asia Monetary Fund. Okay, I think the whole idea is to have a fund that would not follow the dictates, okay, of the IMF or the World Bank. Okay, and a lot of people like to talk about China debt trap and all those. Okay, like Sri Lanka, you know, people say it's a debt trap and all those. Just for everyone's information, China's debt to Sri Lanka is only 10%. Okay, majority of it is owned by US investors like BlackRock and IMF. They constitute about 70%. So again, it's a propaganda-driven kind of thing, because they want to show that the Belt and Road Initiative is a debt trap, okay? And that is the narrative that's driven by the Western media. If you look at a lot of the economies of the world, why countries suffer so much debt is because of most of the debt is owned to the IMF and World Bank. And how is the debt being borrowed is in US dollars, okay? So if US dollar continue to increase, therefore the burden to service the debt in US dollar becomes much higher. And if you have followed the BRI, Belt and Road Initiative development, there's a lot of websites in that. You know, China has also forgiven debt to African countries. Okay, so majority of the global debt is held, okay, is borrowed from the IMF, and that is in US dollar. So if there is ever a debt trap, then the debt from the IMF is a greater debt trap than any other. And you can see the reason why, okay, a lot of the during the last Asia financial crisis, a lot of the countries that borrow from the IMF, they need a few years of very, very difficult situation before they finally wean themselves off. Okay, so overall, I think if let's say there's an Asian monetary fund, then whatever the borrowing can be done in local currencies and away from the US dollar, then that would be a better alternative than to rely on the IMF, because the IMF major voting power lies with the US. Okay, if the US decides to request IMF to have stern prerequisites in order to secure the funding, then that prerequisites will be implemented. And that is why I think, you know, having an Asian monetary fund that specifically help Asian countries settle some of the financial issues and away from the US dollar is a good thing. Now, let's look at the cycles of inflation. Now, central banks are expected to respond to softening inflation by pausing their interest rate hikes as the harsh reality of the economy bites. Government will ease their monetary policy when the economy sours. That I've already explained to you, because there's no other option, okay? It's always monetary easing, expansion of monetary supply. Investors will shun government bonds, which will force central banks to be buyers of last resort to prevent a default or a debt implosion. So this sets the stage for the next cycle of inflation. And in fact, we are the start of the next. So this chart is a bit old. I think we have come down quite, but I want to show you the 3 cycles of inflation during the 1970s. So we have come down quite a bit, but as I mentioned right now, the the banking crisis have not ended. In fact, the banking crisis in EU has also not ended. Japan is facing a currency crisis because the BOJ have not increased interest rate despite inflation, going up almost 3 times. Then the US is facing a commercial real estate crisis. It's also facing a credit crunch. And as I mentioned, the year-on-year M2 supply of money has fallen to its lowest since the Great Depression. So what will happen is that if the credit crunch came, the CRE, commercial real estate implodes and all those, the Fed itself will have to print money like it has never printed any other before, which means the QE will be tremendous. And that will cause the second wave of inflation. So at this moment, okay, the Fed would, whether the Fed increase interest rate or not, I think by that time, a lot of people would lose confidence in the Fed. And what a lot of the major central banks are talking, including the IMF and the BIS, the Bank of International Settlement, is that the introduction of a CBDC, central bank digital currency. Okay, so very likely in the next spike of inflation, because of tremendous QE, we will see the introduction of CBDC. But CBDC is also another topic, but this is just to show you the cycles of inflation that it will keep on going and going until such time that interest rate will be so high that it forced the entire economy to collapse. And that was what happened in 1980. But what happened in 1980 could be done because US debt was very, very low. Right now, US debt, and if you add unfunded liabilities, which means the Social Security and Medicaid, the total debt in the US plus unfunded liabilities is equivalent to more than 10 times of the US GDP. So that's why I think it's either the US go into a hyperinflation like the Weimar Republic of the 1930s in Germany, or they have to back the currency with some hard assets like gold. Okay, so let's talk about sectors to benefit. Now, I have always been very bullish about commodities. Those people who have followed my webinar would know I've been talking about gold, I think, since a few years back when it's about $1,600 per ounce. And in ringgit terms, I think it was around 140 ringgit to 150 ringgit per gram. But right now, you see gold is, if I'm not wrong, is more than 300 ringgit per gram already. Now, still, despite that, we are still at the very edge of a commodity super bull cycle. In fact, Goldman Sachs thinks that the next commodity super bull cycle will last about a decade. Okay, so this is where it stands at the end of March. Okay, this is the Goldman Sachs commodity index versus the S&P 500 ratio. Right now is at 0.85, which is almost, its lowest in decades. So this was the 1974 stagflation peak, which was 7.54. Okay, the Gulf War peak 8.76, and the global financial crisis peak of 8.24. Now, in the next inflationary cycle, because like I say, no option but to print and print even more, if it goes back just to match the global financial crisis peak, it would imply that commodities would be, the index would grow by 9.7 times. Now, if let's say the index can go up by 9.7 times, you can imagine how high can the individual stocks or ETF that are linked to commodity counters perform. Okay, so my favorite topic, gold. Now, a lot of people like to say that high interest rate equal to strong US dollar and therefore low gold price. It's all propaganda, okay? Because all the narrative are driven from the mainstream multimedia like Bloomberg, CNBC, and all those which want to protect the sanctity of the US dollar, because gold is the anti-dollar. Okay, if let's say gold is the preference choice of people to keep or store their wealth, then people don't require US dollar anymore. So that's why, you know, whenever there's interest rate high, people will say equal to strong dollar, therefore gold have to go down. And this chart will show you why. Now, this is the start of interest rate hikes during the 1970s. Okay, this is interest rate. It goes up. Okay, this is the peak interest rate, but you see gold also reach a peak. Just to show you that this is not a fluke. What we have, okay, is the rise of interest rate after the dot-com bubble. Okay, interest rate starts to rise, gold price starts to rise, reaching a peak in 2011, just as the financial crisis hit. Okay, and the Fed went into monetary easing, gold reached a peak. Then this was the hike during a few years ago, before when it reached 2.5%, we have the repo crisis, we have the shortage of US dollar liquidity and all those, and then, you know, gold shot up to, followed by the COVID year, gold shot up to another peak. Then the Fed started to raise interest rate, and then gold started to trend down. Okay, this is the time when they start to raise interest rate, but you look at gold. In fact, gold right now is about 2,032 US dollar per ounce. Okay, so this is the policy, that strong US dollar and high interest rate being negative for gold. Okay, so the current inflationary pressure is not, you must understand this. Current inflationary pressure is not driven by increase in demand nor expansion of economic activities. It was driven by insane money printing and supply disruptions. If, let's say, the current economy is driven by increase in demand and expansion of economic activities, then yes, interest rate hike will actually taper down the economy, and then the demand will actually fall. But right now, it's not. It's driven by insane money printing, and that money printing, that expansion of money supply of trillions and trillions of dollars need to go somewhere. Now, just for comparison's sake, during the 1970s, 4% of global investors have their assets in gold. Right now, in a similar stagflationary period, but much worse than the 1970s, only 0.5% of the investment population is into gold. If, let's say, they revert back to the peak of 1970 at 4%, that will imply an 8 times rush into gold. Okay, so that's why people need to separate, you know, all the narrative that is driven by the mass media, do a bit more research, you know, and you will see certain patterns. Yeah. So this is Malaysia gold, okay, but this is some days ago. You can see that it has already reached the record high versus the peak in 2020. And I think gold price right now is more than $300 already. So it has reached a new peak, and potentially it could move higher if, let's say, at the end of the day, the Federal Reserve have to print a lot of money, ECB have to print a lot of money to save the governments because they are too heavily indebted. When the IMF like to preach people, emerging economies, about being indebted, sometimes if it's with certain intention to destroy the economy so that it makes it easier for the rich nation to harvest the resources in that economy. So not everything is really black and white, okay? There is a lot of gray areas that you need to discern. So my opinion, companies which are major producers in the sectors that benefit, major producers in the commodities market, including oil and gas, oil palm, etc. So specifically major existing producers. So those producers would actually be better off, okay? Because the next cycle of commodities, we are going to see an upward swing in the price of commodities, okay? The central banks like the Fed and ECB tried to suppress it, but the more they suppress it, it's like holding a ball underwater in a swimming pool. Sooner or later, it will bounce up, and that bounce would be a huge reaction. So companies directly involved in the logistics sector, specifically those involved in the commodities sector, like bulk carrier, oil and gas transportation, I think those could do well. Right now, the fall in minerals price, of course, have affected the bulk carriers. But if, let's say, the commodities super bull, as Goldman predicted, and also as I see based on the chart, fall into place, then those that are directly servicing the commodities will actually do well. And of course, you know, gold ETF is still an ideal inflation hedge. Okay, I think I've been talking about gold ETF since 2018. Okay, when I had my live seminar in Johor Bahru 5 years ago. Okay, I talk about gold ETF. So, and every year when I talk about inflation or commodities and all those, I always highlight the importance of gold, you know, to as a hedge to protect your wealth. Okay, so global stock markets will see a lot of volatility, which will influence the local stock market as the world grapples with stagflation. So because Malaysia market is not big, it will always take its signs from what is happening in the bigger markets. So if, let's say, there's a lot of volatility in the US market or China market, Malaysia would also move in tandem. But wait for the announcement from central banks policy to ease, which will then drive the markets higher. Now, this would push both the major indices and inflation higher, but there's opportunity in that sense because the tech sector then will outperform. But due to inflation that comes with monetary debasement, the gains when measured in gold will underperform because as inflation goes higher, the price of gold will continue to go higher. So even though the tech sector may outperform, okay, in terms of net gains, but measured in gold, that performance may not be as good. So that's why if you are investing, you need to have some inflation hedges, okay? And in that sense, you know, gold actually becomes the ideal hedge, okay, so that you can help to balance your portfolio. Still, this is just my opinion, not an investment advice. Okay, Shane, back to you.
All right, thank you so much, PC, for sharing your perspective on this inflation topic. And I'm sure that many of you here may not understand everything that PC said because this is an incredibly macro session on the global perspective involving geopolitics, involving commodities, trend, and so on. The good news here is that we are going to give you the replay link tomorrow, so you can rewatch the replay link and get better understanding and look at the chart and digest the information. All right. So if you have any questions to ask our speaker today, you may write them in the Q&A box. And since we are running out of time, we can probably just take 1 or 2 questions. All right. I think at 8:30 p.m. a moment ago, the US just announced their inflation at about 5%, which is lower than the market forecast. So what is your view on this? So this is a question by Fong Ken.
I think the inflation in the US, as I say, is still on a downward trend, but it will reach a time where it will create more stress on the financial sector, because we are talking about a credit crunch. We are talking about the commercial real estate. I don't think the 2% can be reached. Okay, even before it reached, I think there will be a lot of prices being exposed. Okay, now right now the banking crisis was because of the high yield in US treasuries. So people move out the money from the banks to put them in money market funds. Now, if interest rate increase higher, then more money will go to money market fund. But right now, since inflation is a bit, I think it was 0.1% below expectation. So that means that the market is betting that the Fed would actually have a pause or less aggressive in their interest rate hike. But can it fall to 2% or not? I don't think it can, because if you really want to follow the US inflation, US inflation all through the years have changed. If you really want to know the US inflation, go to shadowstats.com, where they use the same metrics that were used in 1990s to measure inflation, and based on shadow stats, inflation is actually around 12 or 15%. So the Fed have actually changed the goalposts all through the years. Okay, that is how they actually manipulate the inflation rate. Okay.
All right, thank you so much, PC. The next question is by Zishen. Now, a few years ago, when oil price was around $100 per barrel, there was a rise in shale oil supply, which affected the global oil price. Can you share with us your insight if shale oil production will boom again this time round?
First and foremost, I think because of the ESG policy, there's the funding to explore oil has become more difficult. And secondly, as I referred just now, have a look at Steve and Angelo's website. If I'm not wrong, it's called SR Rocco. He actually showed a chart where the Permian Basin for shale oil, is dropping off. That means that ever since 10 years ago, I think, if I recall it correctly, US oil production have actually dropped 10% from the shale oil. So I think even at that time, a lot of the shale oils are not making any money, because the cost of extracting shale oil is more expensive than normal extraction in a vertical pipe. This is a horizontal drilling where shale oil is concerned, and the depletion rate is very fast. Okay, which means that after the initial hit, the next year you will see a depletion about 40 or 50%. So that shale oil need to consistently look for new oil to keep the share price afloat. But I think it's difficult to do this time because of the restriction in borrowing, and also that a lot of the better basin where they extract shale oil has now depleted.
All right, thanks, PC. So let's do one last question. What do you see about the cryptocurrency adoption? Do you think that it can help in fighting inflation or as an inflationary hedge?
I think cryptocurrency, if you look at the cryptocurrency behavior, let's use Bitcoin as an example. Now, Bitcoin has always followed in tandem with the Nasdaq. Just as the Nasdaq have gained, I think 20% since it reached a bottom, Bitcoin has also moved up in tandem as well. So that's why some people call Bitcoin as a speculative asset. But I believe that Bitcoin is something that will happen to its advantage when the major central banks like the US and Europe, the ECB, start to implement their own CBDC. Okay, and their version of CBDC is actually very frightening. There has been advocates to tie the CBDC with consumer spending to track their carbon footprint. So that means that if you consume too much of certain goods, you will actually deplete your carbon credits. So what happens then? You have to buy additional carbon credits from the exchange to continue consuming. So that is very frightening because and if let's say that happened, then I think there'll be stronger move into the cryptocurrency sector.
All right, thank you so much, PC, for doing this session for us. So if you like this session so far and enjoy the session so far, can you type 1 in the chat box so we know that whether this session has been helpful to you? All right, I think many of you here really enjoyed the session. And don't worry, if there are things you don't understand, tomorrow we will send you the replay link and you can rewatch it again to get a better understanding and to gain the insights better. All right. And of course, just want to emphasize that this is just a speaker perspective, and you're supposed to do your own due diligence to see how you view, where the investment opportunities. All right. So with that, I would like to thank PC Wong for doing this segment for us. Thank you so much, PC.
Thank you, Shane, and thank you all who log in and enjoy the session. Thank you very much. Bye-bye.
All right, so for our next webinar, it is titled Cara Memilih Saham Menggunakan Kaedah CanSlim. So if you want to learn how do we use CanSlim approach to find investment opportunity, to evaluate stocks, please tune in tomorrow morning at 10 o'clock. It's happening on 13 April, which is tomorrow morning. So I've just given you the registration link for you to register for this session. As the title suggests, this session is going to be conducted in BM, in Malay. So if you want to learn how do we pick stocks and evaluate stocks using the CanSlim approach, please register for this session, which will take place tomorrow morning at 10 o'clock. So with that, I want to thank all of you here for staying tuned until the end of this webinar. And you just heard from PC Wong, who is a full-time investor, trainer, and author. All right, so see you guys in our next webinar. Bye, everybody.